All right. Hi, everybody. Good morning on this Friday. Welcome to my session where we're going to talk about stock market cycles. Good day to everybody. My name is Seh Siang. I'm the head of retail research here in Malaysia. I've been with CGS CIMB for the last, if you include the section where I was with CIMB, I think it's about 16 years already. So a little bit about me. I started out doing futures. I was in the futures and option side for about 3 years or so before moving on to the equity side. So I started out as an analyst, both doing fundamentals and technical analysis from 2000 until about 2000, from 2000 until 2006. And in 2006, when I joined CIMB, now most of my work is predominantly based on technical analysis. So just a standard disclaimer. This is just the mostly it's just for educational purposes. And if you do have any investment advisors, please check with your own advisors. Thanks. So these are some of the items that we're going to talk about today. We're going to look at how cycles work and what are they, and just a quick go through about cycles. Then we talk about the KLCI cycle, the cycle that we see for the KLCI or our Malaysian market. Then we'll just quickly run through a few technical picks for the last quarter and beyond. Then I'll go through some of the valuation and topics from the CGS CIMB fundamental research side. Then after that, we just quickly run through what you can do with all this information. So as I mentioned earlier, I'm predominantly now doing most of my work is all done with technical analysis. I still do a little bit of fundamentals, but not much. So most of my work heavily is tilted towards the A side. So I'm going to talk about cycles. So what are cycles? Cycles are, so as you can see, there's Newton's third law says that for every action, there's an equal and opposite reaction. So in markets, how do they work? So a lot of things that most of the times stock goes up, usually it will also come down. So it doesn't go up in one straight line. So it goes up and down and down. So there are cycles that you can find for stocks, for index, for commodities, actually across all securities that you can trade. Okay, so cycles are also can also be found everywhere in nature. So just like sunset and sunrise, you see it every day. You see the water cycle, 4 seasons in a year. In some ways, we can also see the cycles happening as well as the calendar months. Okay, these are the cycles that are very much that's everywhere that you and I see every day. So there are also man-made cycles, just like in music. These cycles are man-made. So the tunes that we play tend to repeat itself. The beats are there to follow. There's also the Olympics and the World Cup, which happen every 4 years, except for last year when COVID hit. So there was a slight adjustment there in the man-made cycles. So, so you know that cycles happen everywhere. But the thing is, in common, what you can see in common in cycles is that they tend to repeat itself. And besides being said, it makes it a little bit more predictable. So in the Malaysian market, there is a 10-year cycle. Everybody talks about a 10-year cycle in the market. So if you go and research and do a little bit of work, you can find, yes, there is a 10-year cycle, but if you want to do it a little bit more precisely, it comes up to about roughly 10.5-year cycle rather than 10 years. So it's not much of a difference. You get a rough idea of how the cycle works for the Malaysian market. Here we see a 10.5-year cycle or 126-month cycle for the KLCI. As you can see, since the inception, this black darkened black line is the 10.5-year or 126-month cycle for the index. So as you can see, the first section of this 10.5-year cycle, we saw a big move up to 540 before it pulled back to 170, and then we saw a sharp sell-off in 1987. So from then we saw a big move up to 1332 and followed by a fall in 261. So that completes the next cycle. So the third cycle starts about roughly in 1998 to about 2009, and from 2009 to about 2019 or so. So from all these cycles, we know that these are some of the things that we can deduce or know that it's going to happen, right? So you can see from the cycles, we can deduce that every cycle brings about a new all-time high. So let's take a look again. So in each segment of the cycle, you can see there is a new high for the index in every segment of the cycles. Okay, so for the upcoming cycle, which the previous cycle ended roughly in, should have ended in June 2019, but we saw an extension that I think COVID hit, and we saw a sharp sell-off before it started to rebound. So now this upcoming cycle, or this 10.5-year cycle, should see a new high for the KLCI index. So that should bode well for if you're a slightly longer term holder or looking to invest for a slightly longer term period rather than your short 2 to 3 months hold. I think this should be good information for you, because knowing that in the years to come, there will be a new high for the KLCI. Besides that, you can also see at the end or close to the end of each cycle, there is a sharp sell-off, and that sell-off usually ends very close to its this red line, which is the 200-month moving average. Okay, that 200-month is most of the time it will be tested. Well, in 98, it surpassed as well, and 2008, 2009 it tested, and in 2020 it surpassed a little bit before rebounding. So therefore, I mean, so at every end of the cycle, there will be a test, and the extension that we saw at the start of 2020 and the fall then actually hit the 200-month moving average and then rebounded. So that tells us most likely the previous cycle or the previous 126-month cycle has ended, and a new cycle is now underway. And thirdly, besides all this information you can get from the cycles, is that cycles are like very much like a compass, and it's not Waze. So like Waze will tell you 200 meters, you turn left, and then go straight for 1 km, and then you turn right. So it gives you exact direction to get to your destination. So let's say you want to go to Penang. Waze will take you to with the shortest route, however you set Waze to be, but it will take you on the shortest route with the exact roads to take, left and right turns. So it gives you everything very exactly. But cycles are very much like a compass. So it tells you if you want to go Penang, you must walk north. Okay, if you walk south, you will never get to Penang. So it will just give you the right direction where you should be heading, and not the exact way to actually take you there. So let's say if you're gonna hitchhike to Penang, the next car that stops for you that is northbound, you will not know where it will stop you, but it will at least take you closer to your destination or to your goal, which in this case for the index is that there will be a new high sometime over the next few years. So with cycles, you know that you are prepared and you are going to hit new highs for the index, and you should be at least be participating in the market going forward. So we zoom in on so this is the zoom in chart of the previous chart. So if you look at the end of the final segment, or the segment that just passed and the upcoming segment, if you zoom in, this is your zoom in chart. So you can clearly see based on technicals, you're moving a little bit away from the cycles and just look at a little bit of technical analysis. Sorry. So if you look at KLCI, they have a double top pattern. Okay, you saw a double top started sometime in 2011, all the way up to about 2020 or so. During the course of that period, it always held up above this double black line that you see. Roughly it's about 1550 to about 1620 or so. Okay, so that has always been the support over the course of about 9 to 10 years. Until the break of COVID, we saw it break down and test the 200 month. After this test, we saw a quick rebound of March 2020 all the way up, but you can see that the index is actually struggling to break out above this previous resistance. So if you look just purely based on technical analysis, it is finding some difficulty trying to break back above this previous double top neckline. Okay, this is what we call a neckline. It's having some difficulty trying to break up, just taking a look from this monthly chart alone. So it could be also, the trouble is, there are huge cycles, which is the 10.5 year cycle, but there are also smaller cycles that you see for the KLCI. We split it into a 42-week cycle, 42-month cycle, the red cycle at the bottom. The green cycle is a 21-month cycle, and the smaller, thinner black cycle is a 10.5-month cycle. So right now the index could be tracking the 42-month cycle, which is the red cycle at the bottom. So the red cycle here, you can see it's peaking in 2021, and it starts to wind off. So to suggest that there could be some sort of a selling pressure heading into 2022. Okay, so again here, so this downward pressure could be forced onto the market by this 42-month cycle. Okay, so if you look on the smaller chart where this rebound started from 1483, it could be due to the 21-month cycle that is pushing towards the midpoint or towards the end of the year before it comes off again. So potentially you could still see minor rebounds that most likely is going to stall closer to this 1620 resistance towards the end of the year before it starts coming off for the rest of 2022. So looking on the smaller term cycles, there could be pressure coming in 2022 just based on this, based on the shorter term cycles. Okay, so but you do keep in mind that the long term cycle now is on the up. Quickly run through the short-term resistance for remains at 1620, and or at least that's the key resistance. Okay, 1620 will be your key resistance, and 1458 or 1450 roughly would be your 200-month moving average. That will be your immediate support going forward. So if we zoom in again, you can clearly see this head and shoulder form taking place. Okay, the green curves that you see forms the left shoulder. The second curve forms the head, and the current rebound that we see could be forming the right shoulder. Sorry, that would actually sort of complete this head and shoulder pattern. So this head and shoulder reversal pattern could be negative only if the index actually fall back and breaks below this 1452 and 1483 support. Okay, so once it breaks that, then you probably see more weakness going forward into 2022. So until then, it looks like for now remains in a very much a sideways trend for the index. You could see swings up and down within this range of close to about 1480 to about 1620 levels, at least for the next few weeks to few months to complete this right shoulder. Okay, so how can this turn out to be the cycle where the longer term cycle takes hold? So when prices actually push above this red line, which is the 200-week moving average, roughly also close to about the 1620 levels. So the key level to watch is 1620. So if the index can push past and hold above 1620 for a month or two, then there is a good chance we'll probably see there will be they will actually eliminate this head and shoulder negative pattern and put the index on course for higher prices in 2022. So, but for now, it remains in a sideways trend, and the odds slightly favors the shorter term cycle of 42 months and 21 months cycle that may actually take prices more towards the consolidation side rather than the big bull market that we are looking to find or looking to encounter over our course of the investment horizon over the next 10 years or so. So as you can see here, although it remains, there is some positive, is that the index is still hold this higher high, higher low for pattern. Okay, until it breaks below this one, it eliminates this higher high, higher low, which is a definition of an uptrend. So if it breaks this and eliminates this and actually fall below this 1452, 1483 levels, then this uptrend is no longer intact, suggesting that the index will probably go into some sort of a consolidation, prolonged consolidation that will last going into 2020. So the long-term support comes in at roughly about 1330. So if this head and shoulder actually pans out and breaks that 1452 levels, then potentially there is a head and shoulder target of roughly about 1271. That is roughly about 18% lower. If it drops to about the long-term support of 1330, that's roughly another 14% lower. That will only most likely happen if it actually breaks this 1484 to 1452 support levels. So for now, I think KLCI should remain at least in a sideways trend where it will probably swing up and down and continues to chop sideways. This is just a very, very short-term chart of the KLCI. You can clearly see this was done in early week. So this was done the start of the week where the market was actually weaker. But over the past couple of days, we have seen the KLCI actually shoot above its 200-day moving average. That should bode well, at least in the very, very short term. If you're a short-term trader where you're looking out for a 1 week hold or few days to 2 weeks hold, I think the market should be at least right for trading in the very, very short term. So knowing cycles, there are two things that you can actually do. So knowing that the 10.5-year cycle is on the upswing, you know that during the upswing, it will actually lift all boats. Okay, the rising tide or the wave will continue to lift all boats. So whether there are big blues or small caps, if this cycle is if we are right on the cycle, it will continue to lift both big and small caps. Okay, stocks. So it's gonna be a run where all stocks will move and not just the big blues will move or even the smaller ones or small caps only. Until then, you can see there are some pressures in the shorter term cycles, but overall, most of the stocks will continue to sort of see improvements from their current levels over the course of the next few years down the line. So there are another way to do this. As you know, I'm a TA guy, so because the short-term markets are doing sideways to some sort of consolidation, and we are not fully out of the woods yet. So we prefer to actually keep our exposure low right now and avoid adding too much position. So we still prefer to play defensive, at least in the near term, until breakout above the 1620 levels. Okay, that is just the personal view of mine. It doesn't mean that CGS-CIMB is promoting that view, but this is at least from the retail side, we are slightly playing on still playing on the defensive side rather than going all out into the market right now. So these are some of the top picks based on technicals. Then I will quickly run through the top picks for the fundamental side as well. If you look on the, we like Gamora, stock code 5398. Gamora has always been a favorite among funds, but this year it's been a laggard. Okay, year to date is roughly down about 22%. We see the potential reactivation of the MRT3 as a main catalyst for the stock. So in terms of recovery play, this one could be one of the beneficiaries. As well as with the upcoming budget later this month, they could also see some catalyst that could bring the share price higher going forward. Okay, so however, there are some downside risks. If this COVID pandemic continue to delay most of the mega projects, it could be a negative for Gamora. So for now, the stock is still at or a buy with a target price of 388 based on the fundamental side. So if you zoom in and look at the charts, this is a very long-term chart. Well, 5 to 6 years is long enough for me. It may be short for many people as well. So it depends on your trading horizon. This to me, a 5-year chart is a pretty long chart. You can see since the peak in 2017, it's been consolidating in a very much in a triangle pattern. This triangle pattern appears to be complete at 260. So at 260 is complete, and now with prices trading closer towards the bottom end of this triangle, from a risk to reward basis, I think there is potential for Gamora to actually continue on the upside. Even though right now you can see it's trading below most of its weekly moving averages, so that is one short-term negative. But from a risk to reward basis, as long as this stock doesn't fall back below 260 over the course towards 2022, I think there is room for it to actually improve in terms of its share price. So you're clearly, this is a clear stop loss. If it breaks 260, you should get out. That would suggest the consolidation is likely going to continue for a while longer. But for now, it's holding steady above 260 and also the triangle, the green triangle support trend line. So as long as it's going to stay above those two levels, I think from a risk to reward side, I think there is upside potential. So the 388 fundamental target is roughly the top end of the triangle, which is the green line on the top end. So there are further slightly a bit more resistance at about the $4 to $4.24 levels. But if those are taken out, I think there is a good chance over the course of the next, this would most likely be a few months to few years sort of target. There may be a retest of the $5 levels if it doesn't break below the 260. We also like Tongguan. Stock code is 7034. Well, Tongguan did admit that their expansion plans face some difficulties. I think it's not just Tongguan. I think it's across the board. A lot of people would face a lot of difficulties because of this the current pandemic. So they did mention that they had some difficulties in foreign workers in Malaysia, as well as the closure of their borders in Myanmar, which actually stopped their construction of the new plant. So one thing good about Tongguan is that they have actually found a so-called blue ocean product. Okay, it's called the nano stretch films. These films are actually thinner than the conventional stretch films. They are riding on the developed markets where rising demand for premium and so-called environmentally friendly stretch films, as well as the pickup in the e-commerce that we see because of the pandemic. So this is a plus point for Tongguan, with the stock now doing almost at full capacity. Any expansion of their new plants would actually be beneficial for Tongguan going forward. So we still have an ad call for Dongguan, mostly for its growth outlook and the target price of 378. So there are some downside risks, which is the delays or the extension or of the current pandemic may actually delay this capacity expansion for Dongguan. So from a chart perspective, you can see Dongguan also traded very much sideways since 2016 up to about 2020 before this sideways move was in a range of $1 to $2. Since then, since the mid of 2020, it broke out of this range and hit a high of 330 before pulling back to the $2 levels where it found support. What was previously resistance now is acting as support. So since that 193 low in this year, the stock has actually formed higher highs, higher lows. That is actually the definition of an uptrend. So potentially this could be the start of a new uptrend for Dongguan. So in terms of trading, for the slightly longer term, your stock may be placed below 239, but long term, as long as it doesn't fall back below the $2 line or the 200 week moving average, which is about 196, as long as it doesn't fall back below those levels, the long term, the very long term view for Dongguan should still be up, given that the recent pullback has actually found support at the $2 levels. So your $2 levels will be key level, a very, very key level for Dongguan. So you can see there's not much resistance on the upside except for 330. So there is a lot of room for Dongguan based on its charts to actually push higher. Okay, so as you can see, all its moving average are also still rising. That also implies that the uptrend since 2020 is very much still in. We also like Wellcome. Okay, Wellcome. The stock code is a 7231. We like it because of the recovery in the global economy has seen well-cost products being sought after by customers from the US and Asia. However, there is also Wellcome had needed to actually adjust their efficiency and control their cost better because there was some rise in raw material prices across the board. So sorry, there is a short negative for Wellcome, but nonetheless, we have an ad call for Wellcome with a target price of 122. Like I said here, we like Wellcome because of its defensive demand for industrial hoses. It also has a strong, robust, strong balance sheet. Okay, that comes in about net cash of roughly about 16 million or so, and also what is most attractive to me is which is the dividend yields of roughly about 5.7 to about 7.5% expected dividend yields. Okay, of about 5.7 to 7.5% going forward over the next couple of years. So there are again the re-rating catalysts or the plus points, stronger than expected demands for industrial hoses, but there are downside risks again because of weaker than expected export and local demand, as well as the strong price competition locally. If you look on the chart side, this stock has yet to break out. Since the sharp fall in 2020, prices have recovered pretty fast. Okay, it's now back above this double band that held the support over the course from 2015 to 2019. Now it's back above that level, but it remained below the thick black line, which is the resistance trend line that comes across from the high of 150 all the way down. Now roughly is about 115 or so. So it's now caught in a range between 96 and about 115, 120. So we think that at least this is, from a chart wise, this is a pretty good level to get in, or at least participate in the potential breakout of Wellcome above this 115, 120 level. Here, because from a risk to reward basis, your stop should be placed marginally below the 96 levels. So if it drops below 96, then you should at least get out first. And for those who actually want to wait for the breakout above 115, 120 would suggest that the uptrend, at least the consolidation from the 2016 high is completed, and a new uptrend or is now surging to new highs. It's possible for Wellcore on the breakout above 115, 120. Again, if you look to buy on the breakout, your stop should be kept below the 96 levels. So these are the picks on the fundamental side. So we just quickly run through. I'll quickly just run through the slides. Gamora is again one of the three picks. Again, this MRT, as I mentioned, MRT3 remains the key catalyst. We also like Inari for its potential M&A play and stronger RF chip demand globally, and as well as potential new customer wins. We also like Public Bank as our top pick for Malaysian banks because we believe in its defensive qualities. Okay, the top picks also includes MMB, DKSH, AITA, HSS Engineers, Hapseng Plant, DIY, MSM, Genting Plant, Petronas Chem, and Lotte Chemicals. So you can see there is a skew towards stocks. We believe that we'll see stronger earnings because of the relaxation of the MCO, as well as strong commodity prices. So for now, we maintain our KLCI year-end target of 169. And our view is that investors are most likely going to position into recovery stocks in the fourth quarter if they have not already done so in September. So these are just the three picks and why, the reasons why we actually picked them. Probably will not run through all of them, but you can actually find them. If you're a client of ours or client of CGS CIMB, you can actually find all these items in the strategy reports on iTrade. Okay, so if you do miss all this and you want to find out more, be a client of ours, it's all on the strategy reports that are listed all on iTrade. So these are some of the key picks from the big cap to mid cap sides. The one highlighted in blue is our top picks that I mentioned earlier. The rest are our picks that are buy calls for the rest of the year and going forward as well. So I'll leave this here for a second. You can take a picture of it if you're not a client of ours. And as I mentioned earlier, all these tables and stocks picks are all in the strategy reports on iTrade. These are the smaller cap picks across here. I think we have roughly about slightly less than 20, but these are some of the small cap picks that we like. That we think that has got potential to actually outperform the market over the course of the year or so. Okay, now that I've gone through our picks based on technicals as well as on the fundamental side, there is a need to actually have a plan, right? So you already know, or at least I have shown you the cycles of our market. So you can actually now plan your trade, and then after you plan the trade, then trade that plan of yours, okay? So if you're an investor, what can you do? So to me, investors is someone who has an investment horizon of 12 months or more. So he or she looks further down the road and sort of like ignores the shorter term noise in the market and see the swings in the market is not so important to the longer term investor. So with the information that the cycles that I mentioned earlier can give you, especially the 10.5 year cycle, what can you do? As an investor, you can actually start to look to accumulate fundamentally strong stocks. Okay, so if you don't know what are fundamentally strong stocks, you can take a look from the list that I've shown earlier. You can pick some of those. Again, do not just pick one and put everything into one. Look to diversify a little bit. A portfolio of roughly 10 stocks would be should be diversified enough for a retail participant. So again, so you look, any weakness should provide if you see weakness in the share price that are fundamentally strong, I think it's actually a good time to start accumulating them. But however, again, this number 2 is slightly more extreme especially for more for the pros, or at least those who have got more experience in the market. If you see a strong run in the market, you should look to take some profit off the tables with the intention of buying back later at a lower price. Okay, that again, I have to stress, number 2 is mostly for someone who has experience in the market and not someone who is just starting out. So if you're just starting out and looking to look for stocks and hold, or for the slightly longer term, the cycle actually, the current cycle should bode well for you going forward over the next 5 to 7 years down the line. So if you're a trader, if you're a short-term trader who like me looks at some slightly shorter term moves, so again here I just split trader into 3 types, which is the short, medium, and long-term traders. So they tend to trade more of towards the swing side if you're a medium to long trader, and more of a scalp side if you're on a short-term trader. So with the information of cycles, what can you do? Well, you still need to incorporate a little bit of your TA and hopefully allow you to reap the benefits of the cycle that will move all stocks. So firstly, you want to be trading stocks that are on an uptrend. Okay, so how do you define a trend? You can easily use a moving average. So if you want to use a 200-day moving average, as long as the stock is trading above the 200-day moving average, it tells you that the stock is in an uptrend. Okay, there are of course circumstances that trading above 200 doesn't mean anything, but yeah, so it's just a quick and easy way to define whether the stock is in an uptrend or not. It has to be trading above its 200-day moving average, and preferably the moving average or the 200-day moving average is rising and it's not flat. Okay, so you want to be trading stocks that are on an uptrend. Secondly, you need to have an index filter or a regime filter. So we here in Malaysia, we can use the KLCI as a guide. Yeah, as long as the KLCI is in an uptrend. Again, when the KLCI is in an uptrend, you can use moving averages. You can use a 50-day moving average for KLCI, a 200-day moving average for KLCI. So if the index is also up, that will most likely also increase the chances of your stock also outperforming its compatriots. Okay, so there is a good chance of you getting the outcome that you're looking for if both the stock is also on an uptrend and also the index is also on an uptrend. So besides that, you could also you already know what sort of stocks to buy. So you need again, like I mentioned earlier, need to build a basket of stocks and never just buy one stock. Okay, diversify should be the best way for you to actually to eliminate most risk, at least in the stock market. Although it will never be zero risk, there will be risk in everything you do. So at least by diversifying, you will actually reduce the risk. Okay, so with that, by building a basket of stocks, how much should I buy each? Easily, if you're trading, you have an account of 100,000, just split them up into 10 portions of 10,000 each. So you buy each stock at 10,000 worth of shares for each. So that will actually just give you a simple way to actually position size your portfolio. But of course, there are many ways to do this. There are volatility based, there are time based. So again, all these things, once you're more experienced, then you will probably be able to adjust once you go forward. So besides those, you also need to keep records of your buys and sell. Why did you buy? And review them over a course of maybe say every quarter. Go through your stocks. Why did you buy them? what was the mistakes I made, and try to eliminate these mistakes as you go forward. So these are some of the things you can do as traders. So with the cycles I mentioned earlier, you can use your moving averages and the stock index filter to actually help you in picking the right stocks, at least for the short term. So that would actually end my presentation, but just quickly run through what we have in CGS CME. Every day we have a product called Transporter. In Transporter, we cover stock picks. Okay, we cover the index, the outlook for the index, as well as two stock picks in Malaysia. They can be buy calls, they can be sell calls, but we have been keeping buy calls for now and at this point in time. We also cover different regions. We also cover Singapore, Hong Kong, US. So there will be stock picks every day. Although it will be one each for the other countries. Only Malaysia has got two stock picks a day. And these picks tend to be more skewed towards the trading side. That could take you from 2 weeks to 2 months. Okay. So that is more, if you're looking for fundamental views, we would also have fundamentals reports as well that we pick out from our institutional side. You can also find it on Transporter as well. So be a client of ours and you can make full use of the information that you can find from Transporter every day. And you can find it on iTrade before market open every day. So I think that it actually ends my presentation for today. I do hope there are some questions that I will answer. I can take your answer right now. So there is a question on, given that the pandemic, how do you perceive the investment cycle in the coming months and years? Okay, as you can see from the cycles itself, at the end of every 10.5-year cycle, let me just go back to the chart top end. See, at the end of all cycles, you find that the market or market sentiment is usually very negative. Okay, at the end of 87, there was the Black Monday crash. At the end of 98, 97, 98, we were in the Asian financial crisis, in the global GFC as well in 2008, 2009. So at the end, where we see the pandemic, when this could potentially be the negative that is actually sort of like the negative or the weakest part of the market. So the pandemic is most likely it, and from then on, things should start to improve as the cycle starts to push higher. So things start to improve. It will still be negative over the course of the year or two, but if you're looking out, you are sort of like discounting the fact that this pandemic is already here and the companies are already readjusting to this negative pandemic. I think the cycle should remain. I think the cycle should continue at least over the course of the next 10.5-year cycle. We should actually see a new high for the index. If that is so, I think most stocks will continue to rise over the course of the next few years. I think that should actually complete my section. I don't see any more questions that are coming through. So I guess that's all I have to share with you today. I guess with the information that I've shared with you earlier, so I hope you can actually be well prepared. Cycle gives you a good predictive tool that you can actually use for you to actually prepare for the good and bad times. As you can see, the current pandemic is the bad time, and at every end of the cycle is usually bad, and that is usually the best time to actually start investing for the slightly longer. So with that, I'll end my presentation today. Thank you very much, and good luck and all the best.